Hey guys, my name is Gareth and welcome back to my Finance Fitness YouTube channel where I break down personal finance, investments, real estate, stock markets and help people achieve financial freedom. So if those are topics that interest you, make sure you subscribe to the channel. You can also hit the notification bell so you receive an alert whenever I upload a new video. Something people have been asking me a lot recently is how the stock market can be so high even though we're in one of the worst economic storms in recent history. How can they be so disconnected, and does that mean we're due for a stock market drop? Well, now let's take a look. We are still in the middle of a global pandemic. At the beginning of August 2020, we're still seeing an increase in the number of cases, reaching over 19 million worldwide. And as you know, there are many countries and states that still have strict lockdowns in place. Some countries have relaxed their lockdowns, like here in Europe, while other countries have continued to increase their lockdowns, like my home country in South Africa, where they now have a curfew and they've banned all alcohol and cigarette sales. And as you would expect, these lockdowns have caused a lot of economic pain. People are forced to stay home and companies are not able to generate revenue, and this means that they have more difficulty paying their staff and suppliers. And with suppliers not getting paid, it means that they struggle to pay their staff and suppliers, and so on. We've seen unemployment numbers around the world increase sharply, with the US hitting 14.7% unemployment earlier this year, up from less than 4% at the beginning of the year. Also, if companies are not making profits, it means they're not going to be paying taxes. And that means that governments will be getting less money in and need to borrow more in order to implement their service delivery. So it is clear that the economic impact has been massive and it's going to take us a long time to recover from this. Yet when you look at the stock market, it just keeps going up and we're nearly at all-time highs. And I found myself wondering how to make sense of this. We're in the middle of a total economic disaster, yet the stock market keeps shooting the lights out. In my opinion, probably the most important thing to remember when you compare the stock market to the economy is that the economy is looking at the past, where the stock market is looking at the future. Just recently we saw that the US economy contracted or decreased by 32.9% in the second quarter this year. And this is something that's happened in the past and gives us a clearer understanding of what happened. And to put that into perspective, it's about 4 times as much as the declines we saw during the 2008 global financial crisis. But when we look at the stock market, the prices reflect the expectations going forward. And so right now, the stock market is shooting the lights out. And it tells us that the stock market is optimistic that this pandemic will pass, that the government stimulus and other interventions will be effective, and that the companies will bounce back. So the economic data is painting a very gloomy picture, whereas the stock market is painting a very rosy picture. Certainly economic data can impact the stock market. If the stock market is expecting positive economic data and prices run up as a result, and then we receive negative economic data, it means that the stock market expectations were wrong and they need to correct, and we'll see a sharp drop in the stock market. And the opposite is also true. Maybe the stock market is overly pessimistic and worried about the economic data and as a result is on a downward trend. But then we receive a positive surprise on economic data that's released. This will cause a jump in the stock market prices. In fact, it's quite common to see a disconnect between the economic data and the stock market, but maybe not quite to the same level we're seeing right now. You may have seen in the news, especially recently, the comparison between Main Street and Wall Street. And this is really just talking about Main Street referring to the economy and Wall Street referring to the stock market. And if we look back just a few months to March 2020, we saw the economy was performing really well, unemployment was extremely low, yet the stock market plunged over 30% in that month. And that's because the stock market was reacting to what they expected the future economic pain to be due to the lockdowns being imposed around the world. And now if you fast forward just a few months to the beginning of August, we're in exactly the opposite position, where the economy is really taking a lot of strain, unemployment has increased sharply and a lot of businesses are struggling. Yet somehow the stock market is nearly at all-time highs. So here are 3 reasons why many think the stock market is due for a drop. And guys, if you're enjoying this video, it would really mean a lot if you just hit the like button. It takes just a fraction of a second and it really helps with the famous YouTube algorithm. Small businesses are the backbone of most economies and also a really big job creator, with many economists estimating that around 64% of all new jobs in the US are created from small businesses. And this is especially so for businesses between 20 and 500 employees. And over the past few months, these businesses have really been struggling, and many of them have had to close their doors permanently. It has been incredibly tough for small business owners to just keep head above water. And if these businesses close down, all of the jobs and all the employment that they provide will be gone too. And with the increase in bankruptcies and people losing their jobs, it could take longer than the stock market is currently expecting for these businesses to bounce back and reach the levels that they were operating at before the lockdowns. And if this economic difficulty is drawn out over a period of time, this could have a negative impact on stock markets. And with businesses closing down, there is also this risk of a potential contagion effect. And this just refers to when one company closes down, how it can have a ripple effect on others. It makes me think of the city that I grew up in, Port Elizabeth, where there's a lot of car manufacturers and many of them are well known, like VW and General Motors. Now, a couple of years ago, General Motors decided to close their factory in Port Elizabeth. And this had a big impact on all the suppliers, the distributors, the dealerships, and the service centers. And so when one business closes, it has this ripple effect through the entire supply chain, especially in such an interconnected world like we live in today. One thing that this pandemic has highlighted to us is how interconnected global supply chains are. There can be a pandemic in one area of the world, and it means that 80% of global medication is no longer available. And this risk has prompted a response from many companies where they're looking to diversify their supply chains and not rely too much on one country, even if it means it's a bit more expensive. But then at least if there is a disruption to the global supply chains, there's a less likelihood that their operations will be too heavily affected. Governments around the world have stepped up with unprecedented levels of support, both to the financial markets and stimulus to their populations. The stimulus has taken many forms, including stimulus checks to families to help them cover their monthly living expenses, grants and loans to companies to help them retain some staff, forbearance on mortgages, and even delays in paying your taxes. And all of these measures will largely have a positive impact on the economy, but many of them are temporary in nature. And as my dad always says, there is no such thing as a free lunch. The vast majority of these measures are temporary and being funded predominantly out of debt. And at some point, that debt's going to need to be paid back. Governments are spending way more than what they're collecting from taxes, and they're filling that gap using debt. It's like if your monthly expenses way exceed your income in your household. It's just unsustainable. And at some point, you're either going to have to cut back significantly on your expenses or find a way to increase your income, or probably a combination of both. And when these interventions stop, it will likely have a negative impact on the economy. Hopefully the economies would have recovered enough and be strong enough to absorb when those interventions are removed, but given the sheer scale of the interventions we've seen, it's likely that there will still be a negative impact. Now, I'm not a doctor and I cannot say if there will be a second wave of infections or not, but there have been many reports by medical professionals that this is a risk, especially as the northern hemisphere starts going into autumn or fall and we see a drop in the temperatures. One could argue, by looking at the infection rates of the US and Spain, that some countries are already seeing a second wave of infections. But it can be hard to interpret these numbers because it is also true that some countries like the US have ramped up their testing, with the US testing around 600,000 people a day, and this also should be considered when you're looking at the number of new cases. Either way, if we see a spike in the number of new cases, this will probably raise concerns that governments will have to reimpose some of their lockdowns, which will again limit the economic activity. And stock markets will probably be quite quick to react to this type of negative news, and we could see a sharp drop in the stock markets. One thing stock markets fear most is uncertainty. So during uncertain times, we tend to see a lot of volatility in the stock market. And again, I can't say for sure. We'll have to look at how the next few months unfold. But if we see an increase in the number of new cases around the world, then this will probably be a negative for the stock markets. I recently did a video where I talked about the top 5 mistakes to avoid when investing in the stock market, and that may be of interest to you, so I have included a link in the description down below. So, knowing all of this, what can you do? Well, it really depends on each individual and your risk appetite and investment objectives, but there are some things that you can do. Many like to use dollar cost averaging because you don't have to try and time the market. Instead, the focus is on just investing consistently every month. This has proven to be a very effective strategy for many. You don't have to try and track the markets, and it's a pretty hands-off approach, and that's why it's very popular. And it could be a good approach for you to use. For those that want to be a bit more active in the stock market, one approach could be to accumulate a bit of a cash buffer. You can do this by saving any dividend and interest you get, maybe adding cash to your portfolio or selling some of your securities that you hold at the moment. Then when you see a drop in the market, you could use that cash and take advantage of some of the lower prices available. And this is the approach that I'm taking at the moment. I'm keeping exposure to the market, holding my investments, but at the same time building up a bit of a cash buffer. And then when I see that there's an opportunity to invest, I'll go ahead and do that. I also sold some of my more risky investments and use it as an opportunity to take some profits and free up some cash. Of course, nobody knows when the market will drop or by how much. And so just bear in mind that by holding cash, there is an opportunity cost, because if the market continues to go up, you're missing out on some of that benefit. And lastly, another way to protect yourself is to add some more diversification to your portfolio, and that way limiting the impact of a potential stock market drop. This can be done by investing in bonds or maybe some commodities. Gold is particularly popular for this because it has a safe haven status. I recently did a video on gold where it was reaching all-time highs and broke through the $2,000 level, so I've included a link to that video in the description below as well. More recently, people have been turning to cryptocurrencies for diversification as well. We've actually seen a bit of an increase in the Bitcoin price in recent weeks. But this is still quite a new asset class and not fully understood, and there's limited data available to know whether it's really providing that diversification benefit or not. So that's it for the video today, guys. I hope you enjoyed it, and if you did, make sure you hit the like button and subscribe to the channel. I really appreciate all the support, and I'll see you next week.